You ever see a company announce these huge sales numbers, like $1 billion, and wonder, how much of that is actually cash in the bank? How much is just a promise that might get broken? Well, today, we're going to pull back the curtain on the accounting that separates those big promises from real profits. We're talking about bad and doubtful debts.
So, here's our game plan. We're going to start with the simple promise, that initial sale. Then we'll get into the messy part, what happens when those promises fall through. After that, we'll see how smart businesses actually try to predict these problems before they happen, how they reward the good customers, and finally, how they put it all together to figure out what they're really owed.
All right, first up, promises. This whole thing kicks off with one simple transaction, a sale made on credit.
You know, every time a business sells something but doesn't get the cash right away, it creates a debtor. Just think of it as the grand total of all the IOUs from your customers for stuff they've already gotten. It shows up on the books as an asset, but here's the kicker. Its real value is anything but guaranteed.
And that little bit of uncertainty leads us straight to our next point, when promises are broken. Because let's be real, in the business world, some promises just don't get kept and some bills will never, ever be paid.
And that's what we call bad debts. Now, we're not talking about a guess or a maybe here. This is a sure thing. The customer's gone bankrupt or they've just vanished. Either way, they've made it clear they can't pay. For the business, that promise is officially broken. It's a confirmed loss.
So where does this loss actually go? Well, it delivers a 1-2 punch to the company's finances. First, it hits the profit and loss account as an expense, which means lower profits. Second, it gets subtracted from the assets on the balance sheet. So yeah, it's a double whammy.
But here's the thing. Just waiting around for promises to get broken isn't a great strategy. The really smart businesses, they try to get ahead of it. They actually predict future problems before they even happen.
They do this by creating what's called a provision for doubtful debts, or PDD for short. Now, unlike a bad debt, this isn't a confirmed loss. It's more of an educated guess. Based on years of experience, a company might say, you know what, about 2% of our current customers probably won't be able to pay us down the line.
And that's a fantastic question, right? Why on earth would you book a loss that isn't even real yet? It kind of feels like you're just making up problems, but it's actually one of the smartest things a company can do.
The why really comes down to two big ideas in accounting. First is something called the prudence concept, which basically says, hey, let's be cautious and plan for losses, but let's not get ahead of ourselves and count on profits. And second, it gives a much more honest, realistic picture of your assets. You're admitting that not every single dollar you're owed is going to make it home.
Now, to get the final calculation right, accountants have this little trick. They separate things into old items and new items. Old stuff is what's already been recorded during the year. New stuff, on the other hand, are the last-minute adjustments made right at the end of the year. And trust me, knowing the difference is key for what's coming next.
Okay, here's the recipe for finding the true expense that goes on the profit and loss account. You start with the bad debts you already knew about. Then you add any new bad debts you just found out about. Then you add the new provision you need for this year. And here's the crucial part. You subtract the provision you already had from last year. Why? Because you don't want to count it twice. This makes sure you're only booking the extra loss for this year.
All right, enough of the doom and gloom about losses. Businesses also have to plan for the good stuff, like when a customer pays their bill super early to get a discount.
And there's a provision for that too. It's called a provision for discount on debtors. A lot of companies will offer maybe a 2% discount if you pay within 10 days. But think about it. That discount is a future expense. It's cash they won't be getting. So, just like with doubtful debts, they have to set aside a provision for it.
And the order you do this in is absolutely critical. You always calculate this discount provision after you've taken out the bad and doubtful debts. It just makes sense, doesn't it? I mean, why would you even think about offering a discount to a customer you don't expect to pay you in the first place?
So with all these subtractions and provisions in our toolkit, we can finally do it. We can calculate the real value, the honest-to-goodness number that actually shows up on the balance sheet.
The best way to think about it is like you're refining something. You start with the big, rough number, the total amount of promises from all your customers. Then you start chipping away. You knock off the definite losses, the new bad debts. Then you sand it down by removing the expected losses, that doubtful debt provision. And for the final polish, you take off the potential discounts.
And this is the whole point of the entire exercise. The ultimate goal of all these calculations is to get to this one number, the net realizable value. This isn't just some boring accounting task. It's about being transparent. It's the company saying, look, here's the amount of cash we realistically, honestly expect to collect from our customers.
So I'll leave you with this. The next time you're looking at a company's balance sheet and you see that final number for debtors, remember the story behind it. It's not just a number. It's a reflection of promises made, promises broken, and the kind of smart foresight that really separates wishful thinking from great financial management.